So, imagine a company buys this massive prime plot of land. But here's the catch. They don't build a factory on it. They don't set up some shiny new corporate headquarters. Nope, they literally just hold on to it, waiting for market prices to soar. So, what exactly happens to that land on their balance sheet? Well, welcome to this explainer. Today, we're diving into the nitty-gritty of Vietnam Accounting Standard No. 05, or VAS 05 for short, to figure out exactly how accountants classify, value, and record these specific kinds of assets. Okay, let's quickly look at our roadmap for today. We're going to cover 1. Identifying property, 2. Recognition conditions, 3. Determining value, 4. Conversion and disposal, and finally, 5. Report presentation. All right, jumping right into Section 1, Identifying property. Getting the classification right from the very start. This is absolutely the crucial first question every accountant has to ask the second a new acquisition happens. Is this building or this plot of land truly an investment? Because honestly, the answer to that completely dictates how the asset is going to be treated financially for years to come. The core difference under VAS 05 really boils down to this. Is the property generating passive income through rent or just sitting there for long-term capital appreciation? If yes, boom, it's an investment property. But if the property is being actively used for the daily grind of the business, manufacturing goods, providing services, or housing your management team, then it actually falls under owner-occupied property. Now, the standard explicitly lists out a few scenarios just to lock this definition in. Say a business buys land purely to wait for prices to go up, or even if they buy land and literally haven't decided what to do with it yet, that automatically defaults to being an investment property. The exact same rule applies to any building or infrastructure the company owns and currently leases out under an operating lease. Conversely, we've got to set some strict boundaries here. If you're building something with the direct intention of selling it in the near future, that strictly falls outside this category. That's just considered inventory. And if you're building a property for your own employees to use, even if they pay market rent to live there, it remains owner-occupied property. Oh, and properties currently under construction that are meant to be used as investment properties later, they don't actually get that official investment tag until they're totally finished. Okay, let's talk about the tricky rule versus exception scenarios, mixed-use assets. Picture an office building where a company rents out 90% of the floors but uses the other 10% for its own headquarters. If those spaces can easily be sold or leased separately, you just account for them separately. Simple enough. But if they can't be split up, VAS 05 says it's only classified as an investment property if the portion the owner uses is considered, quote, insignificant. For example, if a company owns a hotel, because they provide significant services to guests, it's owner-occupied. But if they just own an office building and provide basic security to the tenants, it stays an investment property. Moving right along to Section 2, Recognition Conditions. When does it actually go on the books? The standard lays down 2 strict, completely non-negotiable conditions here. Number 1, it has to be certain that the property will bring future economic benefits to the enterprise. And number 2, the cost of the investment property must be reliably measurable. Now, the standard actually points out that this second condition is usually a breeze to meet, simply because the purchase or exchange transaction itself gives you clear, documented proof of the asset's value. Which brings us to Section 3, Determining value, how we actually price the asset. We really have to anchor ourselves to this foundational term, cost, or WINZA. When you acquire an investment property, the initial value you record isn't just the sticker price. Nope, it includes the purchase price plus any direct transaction costs. That means you've got to add in the legal consulting fees, the registration taxes, and pretty much any other direct expense required to get the deal across the finish line. But it's equally important to know what to leave out. The standard strictly forbids padding the asset's value. You absolutely cannot include abnormal waste of materials or labor during construction. You can't include costs incurred before the property reaches its planned normal operating state, and honestly, any unnecessary initial costs are just completely excluded from the property's recorded value. So what happens when you spend more money on the property after the initial purchase? Well, if you buy a building that explicitly needs an immediate upgrade before you can even rent it out, those specific subsequent costs are capitalized, meaning they get added to the property's total value. But if you're just doing routine, everyday maintenance, that's simply recorded as a regular business expense for that period. All right, on to Section 4, Conversion and Disposal, Changing the Purpose of Use. When it comes to changing an asset's purpose, the way a property is classified isn't just set in stone forever.
Under VAS 05, the classification shifts entirely based on undeniable, documented changes in how that property is actually being used in the real world.
Let's look at this step-by-step lifecycle flow. The exact moment an owner moves their staff into a formerly leased building, it triggers a mandatory reclassification from investment property to owner-occupied. If they decide to suddenly develop the land for sale, boom, it becomes inventory. Conversely, if they pack up, move the staff out, and start leasing the building to a third party, it shifts right back to being an investment property.
Now listen to this, because there is a vital exception to this rule. If you decide to empty out an investment property solely to renovate it, with the full intention of continuing to lease it out afterward, it legally stays classified as an investment property throughout the entire renovation process. You definitely do not temporarily change it to an owner-occupied asset.
Eventually, of course, the life cycle ends, usually through a sale or a financial lease. When this happens, the property gets wiped from the balance sheet. The standard dictates that any resulting gain or loss, which is just the difference between your net disposal revenue and the property's current carrying amount, gets recorded directly as income or an expense on the income statement for that period. Oh, and if you sell it on a deferred payment plan, you record the immediate cash price as revenue today, and that extra deferred amount gets booked as unearned interest revenue over time.
Finally, Section 5, Report Presentation, keeping it transparent with stakeholders.
To maintain total transparency, accountants have to meticulously disclose a bunch of specific elements in their financial reports. They need to state the depreciation methods and useful lives they applied. Crucially, they have to explain the exact criteria they use to classify those tricky borderline mixed-use properties we talked about earlier. Plus, they have to clearly separate out the income generated from rentals and the direct operating expenses, like repairs and maintenance, associated with those specific properties.
And the ultimate requirement at the end of the reporting period? Stating the property's fair value. Even though you record the asset at its historical cost, the standard forces you to tell stakeholders what the property's actually worth on the open market right now. And if you claim you somehow can't determine the fair value, well, you must explicitly document a detailed explanation of exactly why that is.
All of this leaves us with a pretty fascinating challenge to ponder. We've seen just how meticulously VAS 505 categorizes every single brick and plot of land based on its exact current use. So how do modern businesses balance their dynamic, constantly shifting real estate strategies with the strict, unyielding regulatory boundaries we've just explored? Honestly, it's a tightrope walk of foresight, intent, and incredibly precise documentation. Thanks for joining me on this deep dive into the architecture of accounting.